Wall Street in 1929 seemed untouchable. For nearly 10 years, stock prices had surged. Fortunes were appearing overnight, and everyone, from shoeshine boys to seasoned bankers, was trading shares as if wealth were guaranteed. The Dow Jones had tripled between 1924 and 1929. Credit was everywhere. Speculation dominated the culture, and the American dream felt accessible to anyone bold enough to gamble on the market. Then, in October of that year, reality struck with a force that shattered lives, erased fortunes, and pushed the world into the Great Depression. But here's the part that should truly alarm you: the conditions that produced 1929 aren't just similar to today's environment, they are almost a mirror image. And if history shows us anything, it's that markets don't merely dip. They implode when confidence is highest. And they destroy the very people who trusted the system the most. The crash of 1929 isn't some distant relic. It is a template for what occurs when speculation overtakes real investment. When debt becomes a lifestyle. And when governments convince themselves they can eliminate the natural cycle of boom and bust. And here we are in 2025, surrounded by record-breaking stock valuations, unprecedented debt, and a financial framework more fragile than ever. The echoes of that catastrophe grow louder every day. Let me walk you through how the 1929 collapse actually unfolded, why it devastated millions of ordinary Americans, and most importantly, why every warning sign from that disaster is flashing bright red again today. Because understanding that moment isn't just studying history, it's recognizing the trap before it snaps shut. The roaring 1920s didn't begin with triumph. They began with a deception. After World War I ended in 1918, the United States found itself in a rare position. Europe's economies were broken, their factories destroyed, their young men lost in battle. But U.S. industry had expanded during the war. American banks were full of gold, and American companies suddenly faced far less competition. It looked like brilliance, but it was merely circumstance disguised as economic genius. By 1920, the Federal Reserve had slashed interest rates to stimulate growth, making borrowing cheap. A flood of money poured into the economy, and a significant portion flowed directly into the stock market. At first, it seemed justified. Companies were growing, profits were legitimate, stock valuations still reflected reality. But cheap money always distorts. When borrowing becomes effortless, speculation becomes impossible to distinguish from investment. By 1925, something vital had changed. Stock prices weren't rising because companies were becoming more valuable. They were rising because more people were buying. And more people were buying simply because prices kept climbing. It became a feedback loop, a self-fueling cycle that looked like magic but was nothing more than arithmetic. Every new dollar entering the market inflated prices further, which lured in even more dollars, pushing prices higher still. But the true danger came from leverage. Banks didn't just lend for stock purchases, they introduced buying on margin, allowing investors to acquire shares with only 10% down, borrowing the remainder from brokers. Imagine buying a $100 stock with just $10 of your own cash, borrowing the other $90. If the price rose to $110, you made a $10 profit on your $10 investment, a 100% gain. It felt like effortless wealth, and people rushed in. But leverage is a brutal double-edged blade. If that same stock slipped from $100 to $90, your entire $10 was gone, and you still owed the $90 you borrowed. Suddenly, a 10% decline meant total ruin. By 1928, margin buying was so widespread that total borrowed money in the market reached $4 billion, around $60 billion today, concentrated in the hands of speculators piling into a market that had already tripled. The similarities to today are nothing short of chilling. In 2025, margin debt is at historic highs. More money has been borrowed to buy stocks than at any point in history. Just like in the late 1920s, cheap central bank liquidity has flooded markets, inflating asset prices far above any reasonable valuation. And just like then, everyone, from day traders to pension fund managers, insists that this time is different. That technology, regulation, and government intervention have somehow abolished the possibility of a true crash. But what made 1929 catastrophic wasn't just speculation, it was the debt underneath everything. By the late 1920s, ordinary Americans were borrowing at unprecedented levels to buy cars, radios, refrigerators, and homes. Consumer credit exploded, allowing families to purchase things they couldn't genuinely afford with money they didn't truly have. Stores offered installment plans. Car dealerships financed sales. Banks competed to lend to anyone who asked. But this wasn't prosperity, it was illusion. People felt richer because they bought more, not because they earned more. They were borrowing from their future, convinced the good times would last forever. Sound familiar? Corporate America was doing the same thing. Companies borrowed money not to expand but to buy back their own stock, artificially boosting share prices and enriching executives. They created holding companies and investment trusts, complicated structures designed to magnify gains in rising markets. Trusts bought shares in companies, then issued their own shares based on those holdings, stacking speculation on top of speculation. By 1929, some trusts were leveraged 20-to-1, meaning a 5% decline erased them entirely. But investors didn't care. They cared about returns. And those vehicles produced returns that looked miraculous, because they were illusions waiting to crumble. Warning signs littered the landscape. Production slowed. Unemployment quietly rose. Consumer spending strained under mounting debt. But stock prices kept climbing, detached from reality, supported by little more than belief. Market cheerleaders claimed the old rules no longer applied. That America had entered a new era of permanent prosperity. Then October 1929 arrived. October 24th, Black Thursday, began like any normal trading day. But by closing time, the world had shifted. A few big investors started selling. On its own, not unusual. But the market had become so fragile, so dependent on constant inflows, that even small sell-offs cracked the system. As prices dipped, margin calls exploded. Remember, millions of investors held stocks purchased with 10% down. When prices fell, brokers demanded more cash. Investors didn't have it. They had borrowed to the limit. Forced selling began, pushing prices down, triggering more margin calls, forcing more selling, a death spiral. By midday, panic ruled. The ticker tape fell hours behind. Nobody knew what their stocks were worth, only that they were collapsing. Crowds gathered outside the New York Stock Exchange as fortunes evaporated. Chaos inside the exchange was deafening. But that was only the beginning. On October 29th, Black Tuesday, the real disaster arrived. 16 million shares traded. The system couldn't handle the volume. Prices didn't merely decline, they disintegrated. Blue-chip companies lost half their value within hours. Investment trusts revealed themselves as fragile illusions propped up by borrowed money. The human toll was immediate. People who felt wealthy on Monday were bankrupt by Tuesday night. Men who'd borrowed against homes, businesses, and children's futures owed more than they could ever repay. Myths of brokers leaping from windows spread, though most suicides came later, after the full devastation set in. What destroyed so many wasn't just the crash, it was the interconnected web of debt. When stocks collapsed, margin borrowers defaulted. Banks absorbed losses, then called in other loans. Businesses cut workers. Unemployed workers stopped buying goods. Demand fell. More businesses failed. More banks collapsed. More jobs disappeared. This is how systemic collapse works. Not from a single mistake, but because everything is connected, and the failure of one piece tears the entire structure apart. Fast forward to 2025, the similarities aren't just striking. They're terrifying. Today, we again see a stock market at record highs while the underlying economy strains. Again, we see unprecedented corporate and consumer debt. Again, our financial system rests on leverage, complexity, and blind faith that prices can only rise. The tools differ, but the game is identical. Instead of margin accounts, we have options, derivatives, and leveraged ETFs. Instead of investment trusts, we have hedge funds, private equity, and exotic instruments few understand. Instead of radio and automobile stocks, we have AI, cryptocurrency, and tech companies priced beyond reason. Debt today makes 1929 look modest. Total U.S. debt, government, corporate, consumer, has reached heights unseen in all of human history. Companies borrowed not to grow, but to manipulate their share prices. Consumers borrow to finance everything from essentials to luxuries. And everyone insists this time is different. The Fed won't allow a crash. AI will make productivity limitless. Technology has rewritten the rules. Government intervention can stop any downturn. These are exactly the same delusions people repeated in 1929. But the most dangerous parallel isn't leverage or valuations, it's psychology. In 1929, people believed prosperity was permanent. That the market could only rise. That the old rules no longer applied. Today, an entire generation of investors has never endured a real bear market, never watched their savings halved, never lived through devastation that teaches humility. For 15 years, the Federal Reserve has suppressed every correction, bailed out every giant, and printed money at every sign of instability. Investors believe risk has been eliminated. They forget markets aren't machines, they are natural forces that eventually overpower every attempt to control them. The crash of 1929 delivered a lesson we refuse to learn. When speculation replaces investment. When debt replaces income. When asset prices detach from value. The correction is not just unavoidable, it is violent. And when it hits, it destroys not only gamblers, but ordinary people who trusted the system to protect them. History doesn't repeat, but it rhymes with terrifying precision. The question isn't if another crash is coming. It's whether you'll be among the millions who lose everything. Or among the few who recognize the warning signs in time. Every pattern that ruined lives in 1929 is repeating in 2025, only bigger, more leveraged, and more dangerous. Those who survived 1929 weren't the ones with the most faith in the system. They were the ones who questioned it earliest. They conserved cash while others chased gains. They avoided debt while others borrowed recklessly. They prepared for the storm while others celebrated the sunshine. The coming crash won't merely resemble 1929, it will exceed it. The leverage is higher. The speculation is wilder. The interconnections are more fragile. When margin calls flood the system, when algorithms begin selling, when confidence finally breaks, the collapse will be swift and merciless. But crashes aren't only destruction. They are also redistribution. They shift wealth from the unprepared to the prepared. From the over-leveraged to the liquid. From those who believed in endless prosperity. To those who understood it was temporary. The question is simple. Which side will you choose? History already knows the answer. The only question is whether you're paying attention.